Hello, welcome to another live stream with me, Christian Rauchenwald. Today we are looking at episode number 24, or episode number 21 of Daily Market Mastery. And as always in Daily Market Mastery, we try to use Elliott Wave Theory or the Elliott Wave Principle to determine the potential future movement of stocks or indices. If you're curious or if you haven't heard about Elliott Wave Theory so far, I would recommend that you check out episode number 1, which is a little longer but goes into the basics. And additionally, you can use the links in the description below to read this magic book online for free or order a physical copy. And you can also find our one-page cheat sheet down there that summarizes most or if not all of the rules and guidelines that apply to different wave patterns in one handy page. Now, as usual, we aim to have these episodes here last 30 minutes. I'm actually quickly gonna start a timer. There you can go, you see. And last but not least, before we jump into it, keep in mind that everything that I'm sharing in this video / live stream, depending if you're watching it now live or later as a recording, is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. And with that, we actually jump straight to the desktop. You can see here Motive Wave, where we left off yesterday. Unfortunately, I still have to find the time to look into why from Interactive Broker for certain stocks we don't get proper data. Like here for Disney, the stock splits have not been properly adjusted, making the data for us unusable. But yeah, it's not the highest priority on my list right now. Right now, what we're looking for is actually something new to look at. So we take the economic calendar, we check earning reports. So in blue, we already looked at AMD, Ford. We didn't look at Solar Edge Technologies. Okay, that might be worth looking at, but the earnings report is already in the past, so irrelevant for us. Why? Because very often earnings would indicate, okay, like either people are happy with the earnings, which means the price moved up, or they are unhappy with the earnings, which means the price moved down. So there's very often, not always, but often like a reasonable price movement, yeah, that would indicate a change in direction, or can indicate a change in direction, or the start of a third wave, fifth wave, whatever. And therefore, we're looking for that. We looked at most of this. We looked at most of that. But anyway, let's jump to June and see what's waiting there. We already looked at GameStop. We looked at Domo. I'm not sure if we looked at NEO. I think we didn't look at NEO. So let's pick NEO for today, assuming that we have proper data. If we don't have proper data for NEO, then we just move on to something else because it's like a little bit annoying to NEO. There we go. NEO Inc. Inherit. Yep. So just get rid of the volume. Nobody needs the volume here. We are on a month chart. We can already jump to a 2-day chart. And as usual, what we do, so we have data here from 2018, September 14th, roughly. One of the first things we do is we go to tradingview.com. Also, everything I'm using here is linked down in the description below. I think the only thing that's not linked down there is Wavebasis. But yeah, wavebasis.com is not too hard to remember. Maybe I'll get to update that description at some point. So anyway, we're gonna see, do we have NEO? NEO we already have here. Okay, so that's NEO. And we basically just check, do we have the right history? So September 18th, and logarithmic looks something like this, and fast looks something like this. So that seems about right, yeah. Now, as you may or may not recall, based on the basics about Elliott Wave Theory is about mass psychology. There is like a 5-wave pattern that goes into the overall trend direction, which very often means upwards, yeah. And in the bigger scale of things, like, yeah, we should look on an upwards trend that is like 1, 2, 3, 4, 5. But also there are cases where we look downwards and so on. So like the 5-wave pattern doesn't always go upwards, to say it like that. But what I'm actually trying to say here is that when we have an IPO, we need to find a starting point, and usually we would find the recent low here. Now, in some cases, I'm gonna just get an impulse pattern, Elliott Wave impulse, yeah. So in some cases, or we might wonder, like, what's with this part here, yeah? So the argument here is, if you read the Elliott Wave principle, is basically that when companies go public, very often it's around like when they are mostly, or when the hype is the biggest. So like even before a company goes public, unless it starts with the IPO from day one, not sure, yeah. There would be some company history that we just don't know that might play out as 1, 2, 3, 4, 5, yeah. Obviously not like this, because we're violating a lot of rules here, but so like this, for example, and which means like very often companies go public in the area of wave 5. So either on their way to wave 5 or slightly yeah, at the time they reach wave 5. Yeah, so that's simply the assumption. Yeah, and if that's the case, then obviously the first thing we would always see is a corrective pattern. Now, yeah, like one could argue, because if you make that assumption, the next assumption would actually be that, okay, well, this is then automatically wave 1, and that would be wave 2, and technically we would wait for wave 3 here. Yeah. However, and then wave 4 and wave 5. However, the problem there is, since we don't know any of the data here, we cannot apply any of the rules for that. So instead of like doing like this and trying then to have a guesswork, the usual approach would be, so we pick a recent low, which would be this one, and then go from here. Yeah, so, and then we can, for example, say, okay, what does the auto labeling tell us here? It would suggest, okay, that's how it checks out. Now, if we say subdivide or decompose this, then it would do it like this. I don't agree with that, to be honest. Yeah, but so that's the right icon. Yeah, so I probably would more likely assume that, okay, we're looking at something like this here, 1, 2, and then have to clean that up a little bit. And yeah, then question is, if we then already, so if I just delete this, and no, I don't want to delete the other waves. Yeah, and then I can delete this, and yeah, so because if we use Kennedy channeling technique, so let's say yeah, logarithmic, so if we use Kennedy channeling technique and say, hey, this is our starting point here, then we have our so-called base channel with our point, yeah, 0.2 needs to go somewhere here, with our 0.2 here. Okay, let's zoom in. Yeah, mouse wheel the wrong way. So I don't know why it's not. Oh, now it's snapping. Yeah. Okay. So our 0.2 would be like this, and our base channel would then basically look like this. Yeah. So, and when we have a breakout from the base channel, then that would indicate very often, okay, hey, and it's not even a nice base channel because we have this huge drop here. That one here can also disappear. We would be in a third wave territory. So if that's then a third wave move, then we would basically, yeah, we don't have wave 4 or 5 yet, so that just goes somewhere for now. We actually will add the wave patterns later, so we stick with the channeling technique for now. So that would be wave 1, 2, and then we would be in the so-called acceleration channel, in which we take a parallel through, or a point, our point 1, and whatever high we can find. So initially we would have this high, and then we would take it parallel through point 2, which is roughly here, and we would wait for a breakout. Now there's no breakout happening, so we would adjust this and say, okay, then let's take this high. There's no breakout happening, so we take this high, and then when we then adjust this again for wave 2, so like roughly like this, so having our wave 2 point somewhere here, then we see here's the breakout happening. So which would indicate, based on Kennedy channeling technique, that this would be 1, 2, 0, 1, 2, and that basically that's wave 3, and here we have our confirmation that we're now in wave 4 territory. Yeah. And yeah, labeling wave 4 or identifying wave 4 is in this case a little bit tricky. So I'm just gonna drop it somewhere. If we were to drop it here, it would still be valid. Yeah. However, like now we have a few issues here with the pattern. So first of all, if we were to use Kennedy channeling technique here for wave 4, we actually just need a trend line, and we again zoom in and go over here. And the way we do it, we would basically take the top. We also extend that line, the top here, and then we take the next top and so on. And we basically look for a confirmed breakout. Yeah. So we very often, or if we zoom out again, so first thing, we have our base channel, and we can show the median of the base channel. Second thing, we have our acceleration channel, and once we have the breakout to the bottom of that acceleration channel, we would assume we're in fourth wave territory. And with fourth wave territory, take 0.3, we take whatever high we find, and basically we wait for a confirmed breakout from that high. Now, we also know that very often, but not always, the fourth wave will touch the median or the top of that base channel, which clearly is the case here, and then it just breaks through the channel as if it doesn't exist. Yeah. And yeah, like, but we also have a breakout here. So actually really, that would be something where I probably would have ended up making a wrong trade. Depending on if we bother to try to confirm if that's already a finished fourth wave or not, because we would have not only touched the top of the channel and then the median, but also we would have the breakout, and then although not confirmed, because here it would be shortly confirmed. It bounces off a little bit and then it breaks through. Yeah. So, which makes this a little bit problematic, because like on one hand, we would have indication based on Kennedy channeling technique that we're already in fifth wave territory. On the other hand, we clearly see we are not. Yeah, now if we now go to get a Fibonacci retracement, and let's see where we are on the overall thing. Okay, so we're on the overall thing, not even, we touched the 50% and we are on our way to now, come on, to the 61.8% retracement overall, which however would then be a violation because we cannot go into the 565. Yeah. So that's actually an interesting point here because obviously in an impulse wave 4 never retraces into the area of wave 1. So we cannot go lower than those 565 that we have here or had here. So like somewhere here, yeah, 565, there it was. So otherwise it would not be an impulse wave. It could then only be leading diagonal in that case, which then only would be part of an impulse of a bigger degree and so on, which is not something that should be the case here. Yeah. So as a result, so we actually get an interesting situation set. So I'm going to add a horizontal line and we're going to try to get our, is that 369? No, 565. So basically right now we would have the situation that either it's like this, so 1, 2, 3, this is wave 4, and wave 4 cannot go further than here, so, and eventually we would have wave 5. Although one has to say that while this seems like a simple corrective pattern, this here is in relationship just too long. Yeah, so that wave 4 is just too long, but we cannot change it. So either it's this, yeah, so that would be one thing, yeah, and which would mean, hey, our risk would be at 565 and our potential reward would be a recovery of at least 90% from here. So if we get another Fibonacci retracement, at some point I should remember the shortcuts for those as well, but that one is inversed. So we'd say, okay, we would at least, yeah, like, so you see, we would go at least to like 52 or a little bit above. Yeah, if we turn around right now, if we go further and barely touch that thing, so not touch it at all, then we're talking about like, yeah, 50 still. Yeah, so it's like, yeah, like an incredible potential profit. Again, we're talking over a relatively long time here, but yeah, and that would be one scenario. Now, the other scenario would be, for some reason, whatever, this here is 1, 2, that is wave 3, 4, 5, yeah, which would then mean, so if this here is 1, 2, 3, 4, 5, and that whole thing here becomes wave 1, which would mean that this here has to be wave 2. And then we have 3, 4, 5. Yeah. Now, if this is the case, then getting a Fibonacci retracement, let's see how much better or worse that looks out for us then. So getting Fibonacci retracement, then very often the price would either turn around between 38.2 or 61.8. Yeah. And yeah, like sometimes it might go lower, but basically, yeah, like, I mean, usually it would actually turn around into the area of wave 4 of the previous degree of an impulse of, in the area of wave 4 of an impulse in the area of wave 4 of the previous impulse of a lower degree. So the previous impulse would be this wave 1 and a lower degree would be the 1, 2, 3, 4, 5. Yeah. So if that's the case, the big question would be where the heck is wave 3 and 4 here? Obviously, wave 3 usually is the strong end movement. If we look how it gaps here, that's definitely wave 3 territory, and wave 4 could potentially be that small movement here. But again, then the relationship of those waves just doesn't really make me happy on first glance. Yeah. But then again, usually not always. So if we then get another horizontal line and extend it, then we're gonna keep the retracement for now. Then if we say, for example, wave 4 ends here, well, then we already are below. Yeah, so we already are below that rule, and by a decent margin as well. Yeah, so like, yeah, which means technically, if this is 1, 2, then we would say, okay, how low would we need our stop loss to be to also account for potentially going a little bit below the 61.8 retracement. So, because obviously if this is 1, 2, then there is no such limitation as we cannot touch the 565. Yeah, we would have the indicator that we might turn around anywhere between 1437 and 555, but potentially we could also go a little bit deeper and then turn around. Yeah, so the question would be, yeah, the closer we cut it, obviously, the better our risk reward ratio. But it also means that then if I say, okay, I open a position and our stop loss is 555 and our take profit is I don't know where, it doesn't really matter, because if it's 1-2, then it would be above the previous all-time high. If this is 1, 2, 3, 4, then it would be somewhere, I said, around the 50 range. So still really good. But let's actually check. So I'm gonna check real quick. And if we were to get NEO, no results found. NEO. Okay, there we have it. NEO Inc. Yeah, so that we go. So 790 right now. Okay, so if we were to invest in that, okay, so you guys cannot see that because that's the one thing I'm not sharing on the stream. If we were to invest in that and say our stop loss would be 555, we would right now have a 29% risk on the whatever 1 point something percent that we would risk. So basically we'd have a 0.3% risk and our take profit would be at 50. So like a 530% potential profit of the 1%. So we could make 5 point, or let's say 6% return for our portfolio over time if that turns out right. That's 555, not 56. So 30% risk. So like it's almost, yeah, it's not 10 to 1, but it's like an incredible risk reward ratio. Yeah. Now the question would just be how much lower we would have to get for that to be like an interesting play. So here we would have 211. Which would be 70% risk. Again, from the 1% that we would invest, the 1 point something, so we talk about like 0.7 to 1% overall risk to the portfolio, with still having like a 5 to 6% reward ratio. So it would still be a decent risk reward ratio. Yeah. Now the question would be if we fall below that, how confident I would be in holding it for the rest of the way. But 555 still seems to cut it close, to be honest. Yeah, so 555 again, like because if we label it like this, then yeah, I mean we would also have to work out how that is a corrective pattern, which is a different matter altogether. So because then we would have to has to subdivide into probably that doesn't look even remotely the way it's supposed to be. That also is a little bit off. That may check out, yeah, but again we would have to actually confirm it, which is a little tricky here, or yeah, it would require way more time than we have for one episode. So but basically it's offering, in one scenario we have a clear stop losses at 556, which would be if this is 1, 2, 3, 4. If this is 1, 2, 3, 4, because 4 cannot enter that area. So that would be a clear cut. Hey, if it touches 556 or if it goes below that, so 555, the pattern is wrong. Let's just abandon it, take the loss and move on. Yeah? On the other hand, with the second labeling that we have, we still have the option to say, hey, 555 would be a reasonable point of turnaround for wave 2, which means it will not be exactly that point, or it would not be, but it could be a little bit before, it could be a little bit below. And the question then, as said, would be like, what's a little bit in this scenario here? So if we say here, let's say 450, then we have a 40% risk, so 0.4% risk with, again, a 5.3% reward. Yeah, so that's still good odds. So I think we're gonna do that. Yeah, so I think we're gonna do that. It's like, again, it's like only a small portion of the portfolio. The two variants, how we can label this, again, we didn't confirm it on a lower degree, but the way this checks out, 1, 2, 3, 4 not completed if we use Kennedy channeling technique, because there is no way with Kennedy channeling technique to have here 3, 4, 5. Would mean, okay, we actually have the hard stop loss anyway at 565. If we don't use Kennedy channeling technique, then we get to the 1, which again would require 1, 2, 3, 4, 5 to be finished here, and then wave 2 I think we actually take the safe route here. We're gonna, so we're gonna set our stop loss here at 555. Actually, 556 was that point there or not? So where's that? There's that horizontal line. So it should be this one. I don't see it. So 550, or I have to get rid of this one. Then we can see it, or we still cannot see it. Okay, so what's it here? No, not 6. 565. Okay, so if we say 555, we even cut in a little wiggle room or make it 550. And then actually let's get the Fibonacci retracement back. Yep, and get rid of the horizontal line instead. Yeah. So if we do that, then we actually are saying, okay, it's more like this. 1, 2, 3, and wave 4 goes here, and then wave 5 should take us at least to, what did we say, the 50 mark. Yeah, so potentially higher. Yeah, but not always. Again, we're talking also long term here, so there's potential that we again move for months further down here, which we may then use to double down on that position or not, but I don't think we would on this one. And then up, but we could also already be at the turnaround point because we are conveniently within that window that often serves as turnaround. Yeah. By the way, looking at that Fibonacci retracement, just want to use the last couple of minutes in today's stream to reiterate something that we had or that I covered in yesterday's episode as well, where we reviewed our current open position. I'm just going to quickly open this one. So 50%, 50 price target, 30.29 stop, 550 stop loss. And there we go, Neo, and there we go, order filled. So we have a new position open. And that was, so Elliott Wave Theory is based on mass psychology, but a lot of other indicators and quotes are as well. Because, for example, people use Fibonacci retracements. So they would have a retracement here. So if that were wave 1, or they would have put the retracement here and then say, okay, at this level, the price will bounce, or at this level, the price will bounce. Yeah. And if you take a look, what happens is like at here, the price bounces and then bounces again, and eventually it breaks through. Yeah. Then here, this level, it gaps completely. Okay. But then when it tries to recover, it does not make it through this level as resistance. Then it uses this level of support, again, barely reaches the upper level. Again, breaks through, but then recovers from there real quick. Again, doesn't make it up there. Eventually breaks through and now has here resistance, support, and eventually breaks through. And now that support is actually resistance. And so the next level will be this. And the reason why this is because those support and resistance level, even if you don't know a Fibonacci retracement, well, then you would use just horizontal lines and identify areas of support and resistance on your chart. And then basically it becomes self-fulfilling because it's one of the easiest methods, which means a lot of people use it, which means then they place their buy or sell orders there. So if we're here right now, people might have already a lot of buy orders at 555 because, that's the 61.8% retracement. And we also see here that that's like the high here, the price bounced from here. I mean, here it gapped through. If we look further back here, so if I take this horizontal line here and actually let's do it like this, and put it here, and we can see after the IPO, the price started somewhere there, whatever that level is, doesn't matter, and it served as support, until it eventually broke through, which means and then here it served as resistance, and price bounced from here. So it's a lot of people will have their buy orders in that area automatically because that's what they are taught, of support and resistance. But support and resistance is also nothing else but mass psychology. Enough people using that stupid line here to say, that's why I'm going to buy. And if the price were below and we would go up, that's why I'm going to take my profit because we hardly will make it through there. Yeah. And then it's just a question of, do enough people buy here to push through those levels, or do we then have enough people that buy at 555 and then already, at 893, we're going to take my profit again because that's where it bounced here and didn't make it through here and then bounced again and so on. Yeah. And then here, if we extend that further back, let's see if we use the roughly 8 line. Yeah. Then we can see here as well. Yeah. Because it bounced and eventually made it through. So even in the past, that 837 to 8 something line, served as a resistance here. Yeah, so that again would be why people then use it. And with Elliott Wave Theory, it's the same principle in quotes, just that the just using support and resistance to say, hey, it's gonna bounce here and it's gonna bounce there and whatever, doesn't give you any profit target or so, because it bounces here, but it didn't reach that line, so you kept your position open and eventually it went into your loss. Yeah. And Elliott Wave Theory basically just builds up on a lot of very, very basic things and puts them into a framework that's very flexible. On one hand, easy to understand, but the more you dive into it, you see the more flexible and complicated it gets, and gives you more tools to determine, okay, which direction are we going, when are we turning around, at what price level are we likely to turn around, and yeah, like, it just gives you a better toolbox to work with. And yeah, but it's not always clear cut. So as you see here, we theoretically have two options. Again, if we would try to confirm those counts by looking on lower degrees, so basically instead of 2-day, we look on daily, 4 hours, hourly, and so on, to see if we can fit an impulse here, a corrective pattern here, an impulse here, corrective pattern here, and so on, then we would have a bigger confidence, but that would take way more time to work it out, and chances that we make a mistake along the way, especially are higher. Yeah, I mean, there are professionals out there that do nothing but 40 hours per week, apply Elliott Wave Theory patterns, and even they might come up with 2 different counts or so based on just like how they apply the patterns. And yeah, but anyway, so the point I want to share is like that mass psychology aspect applies everywhere. The same would be if we use something like, I don't know, moving averages. When people say whatever, oh, the 200-day moving averages crossed over the 50-day moving average, and that's a buy signal. Yeah, and there are enough people that use that moving average and consider the buy signal and buy then, and therefore they make it a self-fulfilling prophecy to some extent. Yeah. Or RSI, so relative strength index, and so on. Yeah, and then combinations of those. So there are enough people using a specific strategy, and suddenly it suddenly works because enough people, put their money where their mouth is. So if we would have a strategy that says the price always turns around at the 61.8 retracement, or 99% of cases turn around like that, how many people would learn, okay, retracement 61.8 and put all their money there because it always turns around there, and suddenly that actually is what would happen unless some big institutional investor would decide at 61.8 I'm still gonna sell and my whole bag or whatever. Yeah. So anyway, yeah, that's it for today. With that, we have Neo in the books. I'm just going to write it down, actually. So we have what did we say? We have episode number 21 today. And so today we have Neo, and it's the 16th of May, episode 21. And yeah, we basically expected to reach $50 or more, either as wave 3 or 5. Yeah, so depending on our count, it's either 3rd wave or 5th wave, or our count is completely wrong. Yeah, but yeah, our risk reward ratio is good. So even if we might see a little bit more drops here, if we hit the stop loss, so be it. I mean, we cannot always be right. If we take a look at my portfolio here, then you'll see that on average I'm right 53.85%. That's actually not fully accurate because it not accounting, or it's also considering the currently open position. So here it's actually only accounting the open position. It doesn't count the huge winning trades that I made in 21. Yeah, so it's a 0% profitable. So it's only about the open positions, because the 66% is actually only GameStop. And then I was forced to close those positions, because I can only have maximum 20 to 25% invested in one single position as a popular investor, and was then forced to re-enter them smaller again, because it literally blew up the portfolio in a positive way. But anyway, so if we stick with that profitability, I don't know how to pronounce that word. Yeah, sorry, English is not my native language. But if we are profitable more than or 50% of the time, considering that we only pick scenarios where our downside is like 10%, for example, or where usually our risk reward ratio is like 1 to 4, 1 to 5, 1 to 10 or so, it means that even being profitable only half the time, we wouldn't break even, but we would look at huge profits in the long run. And yeah, which is what we've been doing in the past couple of years. Also means that obviously sometimes I'm wrong a couple times in a row or so, or my positions, like now, for example, we have some downside here, which means our portfolio can lose a little bit and could then turn around here, or it could hit the stop loss. Yeah, so like we'll see how it plays out. Overall, as long as we like keep applying Elliott Wave Theory, at least in my opinion, keep applying Elliott Wave Theory and look for the positions where we have like little risk with potential high reward or reasonable high reward, we should be good. Yeah. Anyway, but that's it for today. We're actually exactly going to the 30-minute mark. Yeah, if the blurring effect will show it. Yeah. And I hope you were able to take something away from this. Don't forget, tomorrow we have another episode of Daily Market Mastery. Not sure which stock we're going to look at then. Hopefully we find something that's a little bit more clear-cut. Would be nice to find a clear winner. So something where we don't have to have like, it seems very likely, but so yeah, but we'll see what we find. Anyway, so I said, have a great day. Thanks for tuning in, and then see you all in another episode or in one of my videos or other live streams or